What's up, Empire Builders? Welcome to another video. Today, what we're going to talk about is, did the Fed cause the yield curve? This is a pretty interesting topic that I don't think a lot of people have explored. And it's because a lot of people don't really understand the modern monetary model that's being used. There are two things at play that are constantly being used: money printing, money burning, or decreasing money supply and increasing money supply, if you want to be nice about it, or if you want to be overly technical and super confusing, quantitative easing, QE, and quantitative tightening, QT. So you can directly link each of these to a ripple effect in yield and treasuries, and also to stock market. So there's going to be some interesting correlations that we go through today. This fits in with the yield curve inversion data that we've been talking about recently, and I think you're going to find it really interesting. If you like this sort of thing, take a second, click the like button. This is a brand new channel. Please show us some support. Click the subscribe and hit the bell notification, and let's dive into it. Okay, so quantitative easing originally stopped in 2014, and quantitative tightening, haven't really said, but it was happening through 2019. But it's apparently stopped. And what we just saw about a week ago is that now the Fed has increased its treasury holdings by $8 billion. So is QE4 starting? Is the big question on everyone's mind. Okay, there's been 3 other QEs, or money printing points in time. And they've come, what's been interesting about it is at the bottom of, right at the time they're about to start printing, they most likely stop some sort of tightening, okay? And that is the bottoms of a lot of these 30-year treasuries and 20 to 30-year treasuries, okay? That's this data here. So the blue is the 30-year, and the 20 to 30-year is this red line here. So almost at every bottom, they started QE. How convenient. It's like, it's no different than a pump and dump, right? And if people understood that this is actually how the model is currently working, they'd probably understand and be able to know what metrics to look at to be able to better understand how stock market performance and treasury bond performance actually is, and even currency performance. Okay, so they didn't buy this $8 billion. They did not buy 2-year, 3-month. They bought 7 and 10-year treasuries. Okay, so I put it here. The Fed's QT, or quantitative tightening, usually causes sell-offs in stock market, S&P 500, Dow, whatever you want to call it, and can even cause the inversions to occur because, again, they're causing this effect through so much tightening, okay, and aggressively selling off 7-year, 10-year, 30-year treasuries. And then a certain amount of time goes by, so much of this aggressive tightening happens, and then they start to print again. And during the printing phase, or QE, stock markets see all-time highs. And there isn't like a ton of historical data because QE was the birth child of Bernanke in 2009. So this, I think it started in 2008 actually. So, quantitative easing and tightening itself has only started in 2008, supposedly. This week's spending was only bested by a single week in 2011 when the Fed was running its QE program. Okay, here's your number right here. So what we can put together from all this is that there's a direct correlation between tightening, easing, and softly yield curves. And what makes it even more interesting is that you had the Kansas City Fed president, Esther George, say literally she thought that the Fed could be to blame for the inversion curves occurring. Because right now, it's very interesting. There's a lot of analysts saying that we're headed towards recession. There's the president of the United States talking about it. There's a rift between the Fed and the White House. There is, national mainstream media talking about this recession narrative. Well, that was last week. This week so far, nothing. But last week there was this recession narrative. But actually, we're not in that bad a shape, according to, this is just one piece of data, but this is a recession dashboard that Credit Suisse has created. Okay, recessionary is down, expansionary up, neutral. This is where we are presently. And if you compare that to every other recession since 1973, you'll see that we're not in that bad of shape. We're not in that bad of shape. The yield curve is really the biggest one that people are paying attention to, and that's showing recessionary. And in some people's eyes, because this is starting to face down and because gold is rallying and the US is the only one that's not in negative bond territory right now, that the rest of these will start to slip. That could be true. It might not. So that's, again, one piece of perspective, and then you have some new data here that we can mix in with our inversion data, because you could absolutely say that due to quantitative easing and quantitative tightening that that has affected the yield curve. To what degree, I don't know. Did it cause this? I think that's hard to say as well, but it's definitely correlated. And while that's happening, you have the general public who is absolutely terrified of the stock market, and you have insider trading, not insider trading, but they call it insider trading. It's basically higher up executives within companies that are selling. We're in the 5th straight month now of 10 billion or more being sold at what they call insider trading. So from C-level positions. So there's a lot of sell-offs going on in the stock market. There's the trade war, which is, that's why they're selling off, is because there's so much uncertainty for them. They like things, remember, investors like things nice and comfortable and predictable. You start shaking up anyone's comfort zone for long enough, you're going to get some interesting reactions. Now, does that mean that the world is coming to an end and the sky is falling? It actually doesn't. It doesn't mean that at all. It just means that people love comfort, and when you shake that long enough, they'll do some interesting things that isn't logically driven. It's emotionally driven, based on wanting to, the basics, towards pleasure, away from pain, right? So I find this all very, very interesting. And if we line it up with the data that we've gone over with the inversion data, then this would actually be a very obvious buyer's market for at least the next 2 months. And it's not. So I find that very interesting. And if you think this information needs to get out there, then you can do your job. Like the video, share it around with your friends, share it around with your subscribers, your followers, your fan pages, so on and so forth, and we can help this information get out there. All the links you need, the 3 of them, underneath this video. Thank you so much for tuning in. Be on the lookout, more videos coming soon.